Here we go. Welcome to Momentum Mondays. Today is Monday, March 31st, 2025. This is another episode of Momentum Monday. We're back in our studio this week instead of virtual. You were gone last week, traipsing around the country. So back and refreshed, hopefully. Yes,
yeah, and as a warning to all, I will say, if you drive an EV of any brand and you're driving through the middle of Georgia to the East Coast, plan accordingly. There are not.
Did you have some range anxiety?
Yeah, man, I had to. It was not like going to Orlando, which is weird because when you're for a little geography lesson, if you're going to Orlando from Georgia, unless you're on the East Coast, you're going to be going through very rural parts of Georgia. If you don't know this, most of Georgia, the people is in Atlanta. It's like 80% of the population is within 60 miles of Atlanta. So something like that. Anyway.
Fact check him on that in the comments.
Fact check me. It's probably 60%. They're like, it's actually 62.2999%. So anyway, yeah, some range anxiety. So it was interesting. It's interesting.
Nice. What was also interesting last week is the markets. So let's talk about that.
Let me guess. They were, first, this content is for informational purposes only and should not be considered investment advice. All investing does involve risk, and past performance is not indicative of future results. Please consult with a financial advisor you trust or visit us at momentumwealth.us to discuss your specific situation.
Yeah, that was a good one. It's getting better. Every week it's getting better. You're getting more in tune with things and you're getting in the groove of things. Yeah, the market last week. So we've been talking the past couple of weeks about this sort of capitulation point where the market could go either way. And last week was...
Which way was it?
More of the same. It's just unbelievable. It's like you get to the edge and you could go one way or the other and you just stay there. So there's like no real... From a technical standpoint, at least, there's no real progress being made because it's just volleying back and forth. If we look at the weekly returns for last week, the week of March 24th, we got the S&P down 1.48%, the Nasdaq down 2.33%, the Dow Jones down 0.95%, and the Russell 2000 down 1.64%. We flip over to the commodities, gold up 2%, silver up 3.2%. Man, I cannot talk. 3.26%. Those two are really winning the game year to date, for sure. We'll talk about that in a minute. 10-year bond up 0.07, and Bitcoin actually up last week, 4.10%. I think they're up today. Mm-hmm. We are recording this as the market is opening, and it's down a little bit across the board. Crypto is kind of the bright spot today, it looks like, as far as sectors are concerned. But if we look at year to date, we keep revisiting this. Where are we year to date? S&P down 4.91%, Nasdaq down 8.14%, Dow Jones down 1.95%. Dow Jones doing pretty good, in regards to everything else.
Which is very interesting. When you look
Dow 30.
When you look at the industrials are down the least, but big tech, software as a service, et cetera, is down 8%. That is peculiar.
Well, you also have Russell 2000 down 9.08%.
We made an agreement to not talk about the Russell 2000.
Russell 2000 is just right kind of flummoxing everybody. And then you look at gold, up 17.32% year to date. Silver up 17.74%. We're 4 months into the year. And these are like annual returns that we've gotten in the first 4 months of the year. Three, we're not even in the fourth month. So the first 3 months of the year. 10-year bond price up 3.48%, and the Bitcoin is down 10.74%. So Bitcoin definitely taking it on the chin for the year to date as far as the highest down, but followed not far behind by the Russell 2000, which is just wild. I mean, the Russell 2000's really got some issues.
It's very interesting. If you're more aggressive, specifically in your 401k, because that's the easiest way to get access to the Russell 2000 or the small cap, because that's really, when you see small cap, that's
small
Russell 2000.
Company.
Yeah, that's generally under 10 billion market capitalization. Could it be a buying opportunity? I'm still keeping my bias on all these indices as being good buying opportunities right now. It's definitely, but just, and this is not something that's in the show notes, but to go back to the Dow, the industrials, and then which are going to be your large, more fairly stable companies with respect to their counterparts and other indices. And then you look again at the Nasdaq. It's very interesting because as we go through this and talk about what could be some on the nose reasons that the market's down year to date, what could be some more esoteric analysis of why they're down. It is interesting that if you take it on the nose of economy slowing, tariff generated anxiety, it's interesting that you have the Dow not down as much as the Nasdaq. That kind of leads me to believe that this may just be more cyclical weakness that we're going through, because if you think about what the Nasdaq represents, it's companies that generally use technology to solve problems that lowers cost. So if you're looking at a shifting landscape of how we trade globally, it would lead you to believe that the Nasdaq would not be experiencing the most weakness relative to the other two indices, the S&P and the Dow. So it's very interesting to see that playing out. And again, it kind of cements my current bias.
Yeah, I mean, if you pull out further than that, I don't have a chart for it, but the 1 year, the levels we're at now are pretty much where we were at
September.
September of 2024. Yeah. So I mean, we had a big run up after the election. Really.
Also in the summer, we had a
back down.
That was our Russell 2000 days. Was our summer run up, and then September. Yep, and then after.
That was July of last year, and that's really what you would expect to see with the Russell 2000. The smaller companies generally have a good start to the year. Didn't see that this year, and so it's just sort of one of those anecdotal points. It's like, what's going on, and then there are a lot of things that could be going on. Tariffs certainly are in the news.
Auto tariffs.
Auto tariffs. Yeah, well, tariffs across the board, but specifically auto tariffs this week with what Trump is calling Liberation Day or whatever. Is it Liberation Day or Liberation Week?
Haven't heard. I don't know.
Okay, yeah. Well, he's calling that this week. So I would expect at face value that there would be a lot of volatility this week, and we're seeing that now when the market's open this morning. But, certainly with...
and let's do it, because we never really talk about what tariffs are. Let's just hit on that real quick, specifically about the auto tariffs. A tariff is a tax that is placed on an importer that if they want to sell to the American market, then it's essentially a sales tax. The positive side of that from proponents, tariff proponents, is that it would encourage domestic production. And then we look at auto industries, we are seeing some signs of that. On the flip side, people would say, well, it's going to make products more expensive. Sometimes it does, sometimes it doesn't. It's really one of those things that you have to kind of watch play out. So for instance, the tariffs that were placed in 2017 on washing machines did in fact increase domestic production. It did increase the price of washing machines by roughly 10%. Again, could be wrong. It's been a long time since 2017. But
I mean, I think everybody would agree that the general price of appliances has gone up.
Have gone up. Yeah. Here's to my point. Dryers were not tariffed. They still went up 10%.
Yeah.
They're bought together.
Well, I mean, you're also looking at a point of time during which a lot of things went up during that particular period of time.
Oh, the COVID era too.
Yeah, all of that had an effect. But the purpose, the idea behind the tariff and it being a tax, sort of that corporations are supposed to pay, goes back to the old adage that corporations don't pay taxes. They just don't. They don't pay taxes.
It's either going to be
it's generally passed through.
It's going to be passed through one way or the other through. Yeah, I mean, it's going to higher wages. I mean, it's the same thing with minimum wage. Like, when minimum wage goes up, a lot of times that's an input price of labor that does tend to filter its way down. That's generally not something that's counted in the inflation data. We listened to Jay Powell 2 weeks ago speak about tariffs and its relation to it. They take the same approach with that they're taking with a step change in input prices. So I would not expect to see any headline CPI numbers really reflect whatsoever.
Because of tariffs, you mean?
Any tariff change, but you could have filter down effects. We'll just have to see.
Yeah,
really.
I think that's one of the challenges, though, with doing all of this tariff kind of work, in the environment that we're currently in, when we just have gone through really high inflation, where it's coming down, it's still hotter than people would like it to be. It's still hotter than it's expected to be. It keeps coming back at maybe, not significantly higher, but certainly a little bit higher. And so this just has people, economists included, thinking that maybe inflation is going to be persistent.
A recency bias, which is human nature.
And so that kind of compounds the issue when you're also talking about tariffs, which could also have a price increasing effect, even though it's not technically inflation, to your point.
Yeah.
And so the uncertainty of all of this coming together is like, I get why he wants to do it. I don't know that there's any American out there. I mean, drop in the comments if you are one of those people, but I don't think there's any American out there that would not be in favor of domestic production. I think a lot of people want things made in this country again. And I think that a large number of people, I haven't seen any surveys on this, but just anecdotally, I think a lot of people would be fine with paying a little bit of increased prices. We've talked about this before, and sort of these artisan sort of shops like Etsy, these kind of bear these out, because you can go buy a $300 shower curtain on Etsy, but you can also get one for $20 from Target. So I mean, there's a market for this stuff, of things that are made and produced here in this country. And so I think that's an admirable thing to make something you fight for if you are a president in charge of an administration.
Wants domestic production.
Right. The timing of that, though, the argument could be made that you could push it off a little bit, because I don't think it's going to have an enormous effect on what he's trying to do, which is to curb the spending and, kind of levelize prices. I don't think that it is going to have an enormous effect. And because the other reason I don't think it has an enormous effect is because he's so willing to negotiate on it. He comes out hard-nosed for the first week up to when the tariffs are announced, and then the day before the tariffs are supposed to take place, he's like, no, we're going to, I've talked to these people in these countries, and we're going to come to an agreement where it's going to be lower, or it's going to be like, exclusionary. It's going to be this bracket of things that, make up the most of this industry are not going to be tariffed, or whatever it is. There's some negotiation. And so then the markets respond accordingly, and they kind of, they not skyrocket, but
short-term fluctuations.
Yeah, they
based
go
on
up.
That. Yeah.
And so you're seeing that a lot. And I think he knows that. And this is Trump 1.0 too. It's just the same thing. You can look at the chart and it almost mirrors it exactly. And in April 2018 is when we saw the market kind of, start to go back up after all this tariff sort of stuff. So be interested to see if that is what happened.
Yeah, and these are interesting conversations, and we know these are conversations that everybody is sitting around their dinner table having. And it is interesting because, as investors, we have to look at the lay of the land really agnostically. You have to say, okay, what's going on? What could or could not benefit the market in your limited knowledge base? How can I use this to build confidence in my investment strategy? And so it's going to be interesting to see. And I think that's a great point that Americans of all political persuasions have really unified on over the decades, is there has to be a way to increase better wages at home and domestic production. Now, there's disagreements about how to do it. And I think that's what you're really hitting on is, outcome positive, the process to get there. Could it be done better? And we don't know.
Yeah.
But what we do know is that when you approach these topics and you look at it again, agnostic, I love that term for this, and just kind of see how things are playing out, then look for the angle to build your confidence. Because really emotionally, the number one thing that's keeping you from achieving your financial goals is your mindset. And there are always stories and there's always policy changes that could make you not want to get off of zero. And you really got to address that mindset. And then once you can kind of conquer that and look at things from a very 30,000 foot view and not let different particular political things keep you from investing, that you're going to be successful. If you can get past that, the world is your oyster. And we've seen this for time and time again. We've had the unique privilege of creating a wealth management firm during very volatile, very shifting political sands. Let's say it that swings, pendulum that swings. And there is always a reason if you're allowing the emotional side of your brain to not invest. And if you can overcome that, just going back over the last 20 years will show you again, the world is your oyster. There's lots of success to be had.
I mean, the one positive to it would be this is a great time to start that process.
Oh, the volatility is your friend, especially if you're
young,
really any age. And we can talk about this at a different podcast, but really any age. But yeah, I mean, if you're under age 60 and you're still working, you should be doing backflips and high-fiving your coworkers, because the volatility is the price we pay for returns.
Assuming you have some dry powder or some opportunity for rotation within your own portfolio.
Or increasing your 401k contributions and getting that match if you're not already getting it. Yep. But yeah, so you mentioned too, rising inflation, core PCE, which is personal consumption
expenditures.
I almost said indicator. I almost did it.
That's PCE. That's not it. Yeah, that's not even a thing.
Yeah, I don't know. Did rise 2.8. They were expecting 2.7. Not that big a difference, but it is a difference.
It's trending the wrong way, even if it is slightly.
Yeah,
because you would expect that with everything they're doing. When I'm saying that out loud, I'm kind of wrestling with that in my mind, because, again, he's been in office for like less than 90 days. And so there's a certain part of you that has to wonder how much really can be done, what can be done in sort of a way to see it bore out in the data, because this is not, this is February data, and we're in March. So this is really data indicative of his first, 30 days? Yeah,
I think that to be realistic, to basically preserve your criticism or praise based on the inflation data,
right?
I'm probably going to say 6 months they own it. So when you start looking at the 6th month data, so that's going to be July report for June, I think they start to own that, good or bad.
Yeah.
And I think that's kind of realistic. But again, not much of a difference. Our core 2.8, and really what's driving that is housing inflation. And we can argue over whether or not they, rent equivalent housing, whether or not that is something that is done that accurately reflects, but it doesn't really matter. It's a measurement. They've been doing it for a very long time. It is kind of slow to react upwards, and it's slow to react downwards. So the real numbers, especially if you look at Trueflation, they're going to show you a much lower inflationary report.
Right. They're sub 2% now.
They're sub 2%. That's where we're trending. We are eventually trending that direction. The CNBC business survey is showing 2.9, probably sticking year over year month. So it's month report that measures year over year change. So the report we got today measured February to February of last year. And so, the general consensus is 2.9 sticking throughout the year. If we break above or below, that could help build your bullish or bearish case in the short term as to real-time market reactions.
Yeah. I mean, it's something that's in the news, and you're not, it's also sentiment, and it's also what the consumer sees themselves with their own eyes when they go to a store. Now, the biggest thing in the news was egg prices. It has been for a long time. Those have fallen quite drastically. So, it's just one of those things that you have to kind of...
And oil and gas, if we look at our chart on our crude oil...
That's coming down too.
And we go year over year. We were at 85 this time last year, and we're sitting at 70, as low as 66. So I think that, again, as you get more data, depending on the price of oil and what happens overseas with a lot of the conflicts that are going on, that could really help push down, especially food prices, because it's all transported. That's the main cost.
Everything is transported.
This is true. This is true.
It would affect everything.
So that's good to see for the consumer. We're going to need more data to play out, so we kind of can historically look back and say, this is what's going on. Now, the more that we talk, the less down the market is.
That's always good. Let's keep talking.
We've got to stay here until we see green, because we are making a difference.
We're going to do what do they call it in the Senate, a filibuster?
Yeah, we're going to filibuster.
We're going to filibuster the market.
So let's look at the technical events to watch, because we did see a technical breakdown last week that led to more selling. So what are some things that we need to be looking for here in the short term?
Your moving averages really is what I would say. We talked about the moving averages. Last week it was kind of repaired a little bit from the prior week. So 2 weeks ago, it broke down. A little bit of repair came last week, and then it broke down again at the end of the week. Friday being, definitely the worst day of the week as far as the selling pressure. I think it wasn't exactly 90. It was very close to 90%. We talked about this, before the podcast, but very close to 90% of stocks were down on the day on Friday. And also almost, close to 90% of the volume of the market was selling.
What does that tell us? What do you think when you look, again, purely anecdotally? But when you look back and try to compare, okay, when days like this happen, what is that informing? What data is that giving you?
It's hard to say because it didn't hit 90%. If it would have hit 90%, there would have been some examples that you could go back and look at that would have told you that's the other thing that would what I prefaced at the beginning of this whole conversation is like, everything is almost at the door, at the threshold, and then it either backs off or it goes, it doesn't give us any further indication of what is possible because we're still in this spot where an unlimited number of outcomes are possible. It's possible that we go further to the downside. It's also possible that we see a rally. You're seeing a lot of analysts. Tom Lee is a favorite of yours from Fundstrat. He talks about the possibility that the market is setting up this sort of face-melting rally that's going to happen in the next few weeks. He has sort of a mixed track record. I don't know whether that's the case or not. Certainly, he's a very intelligent guy who manages a lot of money, and so I think it would be not the wisest thing to completely ignore what he's saying, but there are analysts
and we don't use
like
his
that.
data. They do.
Right.
We don't. Data.
You don't know what his data is.
You got to pay us like $50K a year, but we don't use the data that we use is it's not a part of a fund company,
right?
So it's completely agnostic to product, and that's something you do have to be careful for, even with people that you like. Like I like most of what Tom Lee says. You have leveled some legitimate criticism about some of his calls, which is fine, but You've got to also understand there's a product being sold.
Right.
And so that's why we like our data feeds to be.
The one thing I'll say about him, though, is that you have to say something, right? I mean, you're wrong or you're right because you're talking.
Yeah.
And so if you don't say anything, then you never have that opportunity. So, yeah, he might be right. Sometimes he might be wrong sometimes, but at least he's out there kind of giving the public at large kind of an indication of what he thinks. And again, to your point, that's because he wants, to turn those into revenue dollars of people that are listening to him. But,
correct.
So we saw the 200-day moving averages, the prices start falling below those. The other thing I'll say is that there was let me pull this up here. There's a tweet from a guy on Twitter that talks about the 200-day moving average. The S&P fell below it, but the 200-day average itself continues to rise. And so that, for him, looking at this as an analyst, might suggest, and again, the very next tweet is like the opposite side of this. Like there's some other sentiment indicators he's looking at that maybe would lean more bearish, but at least this indicator of the 200-day moving average continuing to go upward is a positive trajectory, even if the index itself is falling below it. And that just means that you want to see those longer-term moving averages start to rise in a bull market.
The trend is your friend at that point.
That's right. Yeah. That's a longer-term trend indicator of what the market, is looking like. But again, that could change too as well. We just have to look what this week is like and get through this week. There's a lot of volatility, I think, that's going to be coming this week. And so I'll be interested to see, where we end the week. We had some failed retests of the 200-day moving average, so we'll keep watching that. You talked before about the lower highs and the lower lows. This is something that you tend to see that's more bearish. And so, again, this whole theme is that there's no clear picture being presented of what we could expect to see. It's very muddied. It's very cloudy.
Which is why you have to work with professionals that understand this, and even with as much integrity and energy that we put into understanding what's going on, you still don't know until you're out of it and you look back. And that's why you don't use things like this to make you shaky in your investment plan. Discipline and focus definitely will win the day during periods like this.
And diversification. As evidenced by gold, silver, that sort of thing.
And today, crypto being
short-term
up.
Treasuries. Yeah, crypto. I don't think crypto is up today.
Well, let's see. Is it?
Maybe it's just not updated on mine.
It's one 1.18%.
Okay, maybe this hasn't revalued yet on my end.
1.18%, which a lot of times, if liquidity is flowing back into the market, Bitcoin is generally going to lead the way. So it's interesting to see that.
Well, we have, anecdotally at least, that's very interesting. We did a sort of a little Q&A session over the weekend with a class that's doing some finance conversations at a church. And we opened the floor to questions, and one of the questions was about cryptocurrency. So it's definitely working its way into the
ether.
Into the consciousness at large, I would say, and it's becoming more of a forward. It's more in the investing conversation than it has been previously. But I still think the message is not as clear as it should be about the purpose of it and what it's for and what place it has, both in portfolios and as a piece of technology or a store of value, rather. I think that it could be, it may have a branding problem, is how you might say it.
Yeah, it is definitely interesting to see. I think, again, if liquidity is coming into the upside, crypto is going to move first, both on the long and the short end. Generally, your crypto is going to be the fastest moving in either direction. We did see, if you look at, you may want to put that chart in on the long short, we did see net short positions were excessive over the last 30 days, to say the least.
Yeah, there's a lot of shorts out there.
So to Tom Lee's point, if we're going to have a rip upward, that could be definitely laying the foundation, because in order for a short seller to make money, they have to buy whatever it is they're shorting, because that's what locks in.
Explain the when we say shorting, there's a lot of shorts out there. What does that mean?
So that basically means where in a margin account, you take and borrow shares to sell at the market price. So think about it like this. If Garrett has a bicycle and it's a common... Okay, you do have a bicycle.
I do have a bicycle.
So let's say if I think, because there's, for whatever reason, if I think the bicycle market's going to go down, I go to Garrett and I say, hey, let me borrow your bicycle. I'll give it back to you in a month. He says, fine, sure. So I take the bicycle and I sell it today for $100, because I think in a month it's going to be worth $20. And in a month, when it's to the price that I think I want to pay for it, I go and buy it back for $20. Give it back to Garrett. I keep the $80. He gets his bicycle back. Now, that works generally at short-term fluctuations. If there's cyclical weakness, shorts can really take advantage of this and use leverage and margin to really push down prices. So the problem is that, if the underlying structure of the market is bullish, that momentum, that downward momentum that's being driven by a net short position by institutional money managers can only last so long. It's kind of like a rubber band that's just being pulled. And so once they figure that they've squeezed every drop of lemon out of their short position, they have to close that position. In order to close the position, you have to buy the stock to return it to the lender. And so all bears eventually become bullish. If you're trading on bearish sentiment, all shorts eventually become buyers of whatever it is they're shorting, and that kind of sets the next leg up in the market movement. But it's significant over the last 30 days, which is perplexing. It's more than in COVID, and as a single 30-day point of data, it's more than the significant downturn we saw at the end of 2022.
Yeah, because I think that there is maybe some opportunity that's being recognized by these large institutional traders that they can make some money on the downside and then sort of on the upside as well. So you see that sort of, what would traditionally maybe be referred to as a straddle, where you're on kind of both sides of it, buying the...
Now, if you make 10% one way and 10% the other way, it's 20% on a 30-day trade. And if you're moving $1 billion, that's $200 million. But these types of institutional games that are played, they create a lot of opportunity, both for on the way up, when if you have a highly appreciated position, they're going to act as agents of liquidity as you begin to offload those shares. And then on the way down, if you have a position that's really pushed down, that's kind of detached from its even the fundamentals or the technicals, you have an opportunity to buy in. And so again, volatility long-term is absolutely your friend. In the short term,
It's terrible.
It can make your eyes cross. But definitely
Don't
in the
look
long
at
run.
it. Yeah.
So that was my Series 7 for Dummies explanation on short selling.
Yeah, you should pitch that as a case, not a case study, but as an example question about bicycles. But yeah, that's good information to have. It's again, there's not really much movement here, and that's the problem. It's that I wish we could come in and talk about some underlying technicals of the market being like extremely good or signs. We still are optimistic about it. But it's again looking at longer term trends. In the short term, I think it's just anybody's guess is what's going to happen. It could go either way. And I think that it's just going to take some time, to your point, and some data to come in and kind of give us a clearer signal. And maybe that will happen in the next few weeks. I certainly hope it will kind of come in and show us some strength because there's a lot of uncertainty just followed by sort of perceived weaknesses going on right now.
Yeah, it's going to be very interesting to play out. We're paying attention to the data. For our firm family, we'll be conducting our regularly scheduled 2Q rebalance tomorrow. So we'll have some good data coming out as far as the changes that were made, positions that were rebalanced, positions
as well as 401k.
And the 401k data is coming out. And if you're interested in what we're doing and the changes that we're making to our firm assets, please feel free to go to momentumwealth.us, give us a phone call. Be more than happy to chat with you and kind of give you some insight into what we're doing. Maybe it can add value to your situation as well. But coming up this week, we have today Chicago PMI. I don't actually think that's hit.
I don't know.
I don't think that comes. I don't think that comes at 8:30. Construction spending, not really anything exciting coming as far as that. ISM manufacturing index, again, I'm not really going to be looking too much into that because the tariff stuff is really going to play with. You can get a lot of noise in the ISM manufacturing index as a result of that. ADP employment report, month that goes on, month after month, those guys are getting to be more and more accurate, starting to like them a lot more than the government numbers.
Really? Because I was going to say the opposite of that.
Really?
Because I've seen so many companies moving away from ADP for payroll. And so you have to question how accurate it is because ADP used to be the de facto standard of payroll. And you've got all these other people coming in. QuickBooks is entering the game, the Gustos, all these payroll providers of small businesses, which is what rule the day when it comes to companies and businesses in the country. They're moving away from that. So I would wonder how much longer they have sort of the claim to this
I get what you're
report.
saying. Yeah, that's very well. I guess I've liked it too late because that's a very good point.
I think it's on the upside. I think we're on the top of the hill.
Yeah. Well, I mean, the government data is not coming out until Thursday, weekly jobless claims. Mm-hmm. Trade balance, not really paying attention to that on Thursday. Then U.S. jobs report, non-farm payrolls and unemployment rate will be Friday the 4th. We'll see. We have had wages going up. We have had consumer spending going down. That's creating a nice spread of discretionary income.
Yeah, but you also have those reports. A lot of these reports that will come out this week are notorious for being revised at some point down the road. So I don't know that I would take stock really of a lot, any of these.
Yeah, the jobs report saw some significant revisions over the last few years. And that just may be the post-COVID era that we're in. We're really pinning down work from home, multiple jobs, freelancing is government increases in employment, government decreases in employment. It definitely could.
I think that's the big thing.
It could be that we're in a business cycle that it's just really hard in real time to pick up the data. It's possible. So we'll see. But I guess, are we at the end of the show notes?
At the end of the show
notes.
We
are at the end of the show notes. Any parting thoughts?
Yeah, I mean, the tariffs conversation is an interesting one. Just kind of keep your eye on the ball there. I would expect going into this week that we will have some volatility. Not going to shock me. Wednesday is Liberty Day, apparently, is what he's calling it. That's the day that the tariffs are supposed to go into effect. So we'll see what happens tomorrow or maybe late night on between Tuesday and Wednesday to see if those actually will go into place.
And what the percentages are as well,
right?
Because this is not just the auto stuff. I think it's a whole bunch of different things. So it's see what that data is.
This has the potential to affect even vehicles made in this country, because there are still
Components.
parts that they rely on that are imported. Elon Musk talking about Tesla being one of them, saying that he's not going to be immune from this either. And so it's interesting. I would be interested to know what the conversations are between those two guys about that, because he still does import some parts from that for those vehicles. So
will there be exemptions for like NVIDIA? Great company, leader, definitely a leader in this new environment, technological environment we find ourselves in. What type of, will there be exemptions? Is Taiwan Semiconductor exempt? How will those play out? That could go a long way into having components that are either exempted or can be easily, using those chips can be easily constructed here. It's going to be very interesting to see how that plays out.
The other side of that conversation.
We need NVIDIA, we need AMD, we need Taiwan Semiconductor if we have a chance at keeping up in this competitive AI race we find ourselves in. So,
the other side of that conversation is the used vehicle market, and will we see some upward price trajectory there? If you have a car that you're trying to sell, are you now going to be able to sell it easier or maybe for more money because of the fact that most likely, if these tariffs do go into place, your cars on the lot will maybe get a little bit higher in price. There's some companies like BMW, I think, that said they're just going to eat the cost of the tariff. They're not going to pass that on to consumers. So you may see some of that happen with
and that's interesting. How could they do that? That's what you ask yourself. It's very interesting with BMW saying they're not going to pass on the prices. It could be that as a result, again, we've talked about how the electrification of transportation will and does push down cost. So they could have a few tricks up their sleeve that we're not aware of as they continue to electrify their fleet that could make them immune to the whole tariff discussion and not be able to pass those costs on. So that's very, very interesting. But we'll go ahead and take a wrap on it. Lots of interesting discussions.
Wrap it up.
And what we like to do, if you can't tell, is do a nice blending of just the conversations everybody's having every day. Do it, sober-minded and with an objective outlook and how that impacts the markets, and more importantly, how it impacts your mindset of whether or not you should or should not invest, and whether or not you should or should not seek out. You always should. And whether or not you should or should not seek out professional help. And if you're on the fence and you'd like to know more about what we do, momentumwealth.us is a great place. We have free calculators. We have lots of content on there that you can really add value to your situation from, even if you never talk to us on the phone or via text or email. So we'll give it a wrap there. You guys enjoy the week.
Thanks for tuning in to this Momentum Mondays. If you've liked this content or found it helpful, feel free to like, subscribe, share with a friend, all that good stuff. Of course, obviously, the more people this filters through, the more people we get a chance to talk to and help.
This is right. You
can also follow us on social media, Instagram.
Yeah, we do some
Facebook,
short videos throughout the week that we're putting out. Some are tongue-in-cheek and a little entertaining, and others are more serious, but all of this, it spans the gamut. All of this to give you a little piece of our mindset and how we help our clients succeed.
Yeah. All right. Well, next week we'll talk about the jobs report and a lot of other things. Maybe we'll get some more clarity, but hunker down for a week of volatility. That's the TLDR.
Ooh, I like that.
Yeah, there you go. And we'll see you guys next week.
Peace.
Adios.